it's time for viewer mail.
Do we have mail?
Yes, we do.
Good.
So this is from Josh in Vermont, and he says, I heard that there wasn't a price for Tokyo Electric stock at one point. They said it was ask only. What does that mean, and how come there wasn't a price?
Good question, Josh. Thank you for that. Doesn't happen very often. If you have a question, please send it to Doug at riskandrewardtv.org, and I'd be happy to take a shot at giving you an answer. The answer to Josh, what ask only means is that there was no bid for the stock, so that there was nobody willing to buy it at any price.
And Tokyo Electric is the one that has those reactors, those nuclear reactors. So all of a sudden,
nobody wants their stock.
Nobody wanted to buy that stock.
That's right. So the way the bid ask system in the markets work is you have a bid price and an ask price. The ask price, let's give an example of, say, $10.25 as the ask, and that's the seller. And say it's $10 even for the bid, and that's the buyer. So the way this works is if you want to buy the stock, you have to buy it from a seller, and the seller in this example is offering a stock at $10.25. So you can't sell it, or you can't buy it at the cheaper buy price. You have to pay the seller's price. If you want to sell, well, you can't sell at the seller's price. You have to sell at the buyer's price, which in this case is $10. So you can't sell it for as much. So there's a difference between the bid and the ask, and that's called the spread. This is the bid-ask spread. And what happened in Japan is there were no bidders. So there were people asking, and they said $10.28, $10, $9.75,
yeah, please,
$8,
please,
$5.50,
nothing,
$1.25, nothing, no ask or no bidders at all.
Crickets on the other end.
Right. So it was ask only. There was the top of the pricing. There was nothing at the bottom, and so the market went ask only, which is very rare. Which is
I don't think I've ever heard of ask only.
Yeah, it's very unusual that it happens. So it's good that we're talking about it. And so there's this fallacy of like, oh, I can always get out. Well, markets can go illiquid, and illiquid means that there's only one side of the trade. I want to sell. Well, if everybody wants to sell, you got to find a buyer.
Your investment evaporated.
That's right. There's nobody. If there's no buyer, there's that's how markets work. As a buyer and a seller, you got to come to an agreement on a price. And whatever price that the last transaction sold at is what they call the market price. And if nobody's willing to move, we saw this in the last housing crisis, where people had mortgage debt and there was no bidders. I don't want any mortgage debt. I don't know how many houses are going under. I don't know how bad it's going to be. Nobody wanted the debt, and the federal government ended up taking it. And so it can be a problem when markets go illiquid. This is a problem. So, but now think about it this way: if you're an investor, like if you owned your house and you weren't going to sell it, does it matter if the market's illiquid or not? No, because you're not trying to sell.
You're living in it.
That's right. So that's why liquidity and having emergency savings is so important, because you really can't dump some assets when you want to. If you'd invested in something that you thought was safe, like Tokyo Electric stock, and all of a sudden your house went down with a tsunami and an earthquake, and now you need that money back, well,
that's gone too.
That's gone too. Well, it's not gone. I mean, they eventually came back with a price, but it's not. You can't wait it out. You can't wait it out. You need the money to rebuild your house. So what you thought was a good investment isn't liquid, and if it's not liquid, you can't use it, which means you have to wait. So that's a big, important lesson in markets, is that they can immediately become liquid, and when they seize, then they cease to function.
Lots of problems. So what's your takeaway?
So the takeaway is, in major events, liquidity can dry up. For investors, that's not a problem. For traders and those that need access to their money, they should have a backup plan.